Hello everyone, welcome back to Chill Trades, the most accurate stock market channel on YouTube. Today we're covering KPLT, Katapult Holdings. This is a stock we cover quite a bit on this channel, so we're going to be going over their earnings since they released that last week, kind of dive deep into how it's looking, the pros and the cons, and then go into the technicals to see where the stock could go. And we're trying to figure out, should we buy here or should we wait longer? If you haven't subbed, please hit the sub button. We're pretty close to 600, so please help us get there. And we have a Discord, so see that in the description as well. So let's get right into things and go directly to the earnings. So earnings, pros and cons. Pro, they beat estimates. That's always a good thing. And analysts were actually expecting the stock to be down pretty significantly in revenue. I think the estimate was around 40 to 50 million, and they came in at 71 million. But when we look year over year, it's not really much of a change. And so, yay that they beat earnings, and that's why the stock one of the many reasons why the stock kind of went crazy. But it's come back down because when we look at the holistic picture, it really hasn't grown much. And so when we look over from September to September, we don't have a huge amount of growth. We haven't broke over 80 million for a single quarter. And this is kind of what I've mentioned in past videos is I love the stock. Valuation wise, they're valued pretty decent if they can stay at this level. But what happens is when a company doesn't grow, people start to lose a little bit of interest. And so with a firm blowing up as much as it is, for Katapult's revenue to stay kind of soft and not really growing much, could potentially be showing some red flags somewhere in their business model. But let's go on to the next thing. So kind of when I spoke to valuation, now we got Ad Central and FinViz. Lord. I'm curious what you guys think actually. Do you think their earnings was good? But looking at the main thing I want to look at here is their forward PE and their market cap. Sorry. So their market cap is right now is at 433 million. And so that's not really too bad based on their sales. This sales is incorrect. They're probably going to close, I think last year, let's go back to it. Last year they were at 247. It looks like we're most likely going to beat this year. And so this is more maybe closer to 300 million. So if we go market cap to revenue, it's really not a terrible picture. Plus we know that the company is showing profitability. I believe we're profitable in the last 4 out of 5 quarters, which is another pro. The main thing is the growth. The growth is somewhat stagnant. And so still looking at all those elements, PE ratio still is a 16 on FinViz. When we go over to this other platform, some comparisons, we have forward-looking, both of these are forward-looking. Forward-looking PE at a 7. So somewhere between 14 and 7, maybe say 20 and 7 or 15 to 7 is probably our valuation. So this is a small industry, so it's kind of hard to compare multiples. But when we look at I would say the mediums so right now, Katapult is, their EBITDA is at 91 times. Oops, I just messed that up. What did I do? Let me refresh this page. Their EBITDA is at 91. Oh my gosh, where did I go? There we go. Is 91 compared to a medium of 71 and a high of 232. And so this is because of Afterpay, and these numbers aren't all the way right for Afterpay, but regardless, Afterpay is wildly expensive. But when we go to PE ratio, it's a 6 on here. Say it's a 15. You know, even though this number is a little bit wrong, let's even go here and go Afterpay. APT. That's not Afterpay. Afterpay. Let's see. I don't think those numbers are correct. Let's go on there. Oh, Afterpay. Okay, I'm thinking of a firm. That's what I'm mixing up my companies. So a firm, yeah, they're crazy expensive as well. But this is a very low multiple company, and the only reason it's staying low multiple is because it's not growing. So Q4 is going to be pretty important. But when we look at the numbers, let's kind of like we just looked, but let's look a little bit larger time frame. This is where we start to see a little bit of warning. So if we look over since 2019 when they went public, we have great growth, great growth, great growth. Then we come to 2020 year over year, great growth, shrinking substantially, basically flat. That's the main issue. That's the main issue we're paying attention to, and we have with the stock. Amazing valuation. Their revenue is stagnant, but they're becoming net income profitable, so that's a positive. So it's like weighing the pros and the cons, and kind of the market we're in right now is that people are chasing growth. You know, things like Affirm, as we use an example, or you look at the chip space, like Nvidia today and AMD. Like, these things are soaring because of growth, and so people get kind of bored without growth. But that's not all we look at on this channel. So actually, let's dive into the earnings. Actually, I want to get to so a couple things. So first, we are pleased to report third quarter 21 represents a step forward in our long-term journey. That's what I'm saying, long-term journey. Long-term. While many of our merchant partners are facing operating challenges stemming from global supply chain disruptions. So we've got to remember that because of supply chain, people's revenue are being impacted, a lot of companies. And so obviously if people are buying things on debt, which is eventually basically what they're doing with Katapult, that is impacting their growth as well. But how much impact? Maybe they're overstepping a little bit. But the main thing here is Katapult grew revenue and gross originations as we continue to deliver high level of customer satisfaction. We have established a strong foundation for the future with a solid balance sheet. I agree. Distinct product offering. I agree. Probably they don't really have any direct competitors. An emerging brand that is driving repeat customers. I agree. So with Affirm going crazy, it is kind of propelling Katapult's brand a little bit, which is a positive long-term speaking. As we look at the remainder of 2021, we're excited for the growth. So they're excited. We'll see what Q4 comes in because that's a big question. But kind of looking here as well, a couple things, like I said, we already kind of mentioned, you know, year over year flat. We are up year over year, which is a pro. But one thing that's interesting is gross profits are actually down year over year. And so some expenses is going up. Something is impacting this business. So let's go into what that is. So professional and consulting fee, that's up. And when we look year over year, it's up quite a bit. What is that? Great question. Data analytics and technology, up year over year. So this is a pro and a con. Because they are already profitable, you know, they're making enough money, they can do with a little bit more spending. So that's a pro, and investing in these parts of the business is important for the long-term growth of the business. So growing their data analytics, growing their technology, these are all going to help in the long-term trajectory of the company. And the balance sheet is still solid enough where they can make these investments. Moving forward, we're really going to want to pay attention to these, because if these expenses continue to go up but revenue stays flat, then that's not so good that's not as of a positive for the company. So that's something we want to keep an eye on. And then general administrative, whatever the heck that means, who really knows? But those are some of the costs that are going up. Things we need to keep an eye on. The other thing I want to really pay attention to is cash. So cash is up year over year. That's really great to see. They're at 99. They're almost 100 million. And so for this stock, this company already to be positive net income. I think they had a little loss here, but year over year, net income positive, even though it's going down. Having 100 million is enough for this company. When you have a company losing, 50 million a quarter, 100 million would concern me. But their net income really isn't. It's basically flat for the most part, or at close to zero. And so that's not really as concerning for me. And so I think that 100 million will be enough. The question mark is if they're going to try to do some acquisitions to maybe grow revenue. That could happen in 2022. If we see revenue continue to stay flat, they might try to go after some acquisitions. And if that's the case, they're probably going to raise money. So things to keep on top of mind. The last thing I want to look at before I get into technicals is institutional buying. So a lot of buying in Q2. Q3, not as much. And it's just because the stock's been going down. It's going down. It's kind of been going sideways this quarter. Well, I guess it went down at the beginning of Q3. I think that was the beginning. And now it's kind of been flat. It's one of these kind of silly runs from short squeezes and such. But it's basically flat. So no one's really interested right now. It's kind of fizzled out. Insiders, so people in the company, we did have someone buying big on Q3. And so that's when the stock dipped substantially. And people bought into that dip. They bought at 3. They bought at 3. So the CEO, the COO, the CAO, general counsel, they believe in the company. And so I like to see, and 300K is a decent amount for a small company. So that's something really good to see there. But let's go ahead and get into technicals. And so let's call it the pros and cons first. So first con is we are back below the 20 moving averages. As I say, the 20 moving averages is always the source of truth for me. So showing that we made this basically 1 day move higher off earnings and have trickled back below the 20-day is not a great sign for me. That's not really what I like to see. So we'll have to see if we stay in this kind of consolidation zone. This little yellow area is kind of what I'll call a consolidation zone. We see it kind of going sideways there quite a bit. So now that we're the 20 EMA, if we get back above and we break above the consolidation zone around 475, that's a really bullish indicator. But if we got rejected off it today, we're kind of stopped in the middle of that candle. We'll have to see if we can get back above or not. If not, we're going to want to look for a break below 435. And if we break below 435, there is a chance, pretty high chance, that we'll come back and test 415. So those are some price points to keep an eye on. We're also on the daily, the RSI. We dipped back below 50, so we had a squeeze higher, and now we're back below. And along with this getting over the 20, I also want to see it get back above 50 here. If we can get back above, even if we go sideways at 50, that's better than breaking back below. So those are some of the big picture things I'm going to be taking a peek at. And if this continues to go down and we see this break towards this 415, if it can't hold 415, then we have a big gap here. And typically, if we break below really major support, as you can tell, there's like 5 candles at that major support. If we break below that, there's a pretty high probability that we're coming back to either 385 or the full gap at 365. So look for somewhere in that range. If we go back to the $3 range, this is where I'm definitely going to consider buying some shares. It would definitely be worth it. I think that looking at this company, it's about, what did we say, 500 million valuation right now. I'm on the wrong page. Let's go back. We're at 430. So if we go back down another 30%, what are we at, 300 million or so? That's really compelling for me, knowing that revenue's about there, we're net profitable. Those are all good pros. If we buy there, maybe we could go lower, but that's where I'd continue to buy more shares, because long term I do believe in this company, in this sector, and so coming down here is definitely an opportunity for you to pick up shares back below at a lower price again, if it does. If we do break above the 20 moving average and we break above 475-ish, then we really need to get back above 530. So when we jump out, 1 candle, 2, 3, then we have a bunch here. We have all this nonsense, and then obviously we have this. So I think going a little bit higher. We have all this first. So we have all these candles right here. If we get above 530, we have about $5.75 to $6, and that would be the previous high. Honestly, I think that's more unlikely at this point. Just kind of seeing the momentum, shorts are kind of coming back into the stock, and so I would say the highest probability is either for us to go sideways or for us to dip back down a little bit. You never know. The IWM, which is a Russell 2000, has been dipping, which has been causing more of a negative force on these kind of companies. So if we see the IWM, kind of bottom out and go back up, we could see rallies in these stocks again. But look for these price point zones as places to buy. If you believe in this company as I do, I kind of detailed out pretty significantly their finances. They're looking good. The only big question mark is their revenue growth. And as supply chains kind of figure itself out, and they already are, we'll have to see if revenue grows with that. That's all I have for you guys today. Please come back on Friday, doing a live stream at 7:30 Central Time, and I'll see you then.